Some hedge fund managers are diversifying with gold to reduce risk and support returns, including two maverick investors who won big betting on the 2008 financial crisis. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe, and we'll keep you in the know. Central banks have been getting a lot of credit for gold reaching new heights, but some analysts say hedge funds are playing a sizable role as well. According to James Steele, Chief Precious Metals Analyst at HSBC Securities, the rally has been fueled by a powerful cocktail of safe haven and hedge fund purchases, prompted by record high equities and sticky inflation. One hedge fund manager, David Neuhauser, of Livermore Partners, indicated recently that his weighting in gold has climbed to more than 20%. With inflation well above trend and being extremely sticky, it doesn't take a rocket scientist to figure out that gold could serve in a great capacity. Neuhauser added, "We are in for a structural change in terms of inflation, and gold will be the metal for investors worried about monetary disorder, worried about monetary debasement." Neuhauser also shared his forecast that gold could be at $3,000 within the next few years. Another renowned hedge fund manager, David Einhorn of Greenlight Capital, has taken a very large position in gold, stating, "There's a problem with the overall monetary and fiscal policies of the country, and if both policies are systemically too loose, I think the deficits are ultimately a real problem. And I think that this is a way to hedge the risk of something not so good happening." Among the most notable hedge fund managers turning to gold are Michael Burry and John Paulson. 17 years ago, Burry made hundreds of millions and Paulson made billions, shorting the housing market with derivatives. Paulson, along with Burry, whose story was immortalized in the book and movie titled The Big Short, were roundly hailed for both their foresight in seeing the trouble brewing and for having the courage to wager so big on their projection. And now they're each investing in gold. According to a recent regulatory filing, Burry made gold his fifth largest position last quarter, an allocation worth roughly $8 million within a portfolio valued at a little more than $100 million. Paulson's gold commitment is much larger. According to regulatory filings good through the end of March, he made a $400 million commitment to the gold sector inside a portfolio valued at $1.45 billion. That's an allocation of nearly 30%. In an interview last year, Paulson made his long-term case for gold. "We're at the beginning of trends that are going to increase the demand for gold, and inflation and geopolitical tensions will determine the rate at which gold increases. This year, gold will appreciate versus the dollar and also over a 3, 5, and 10-year basis." And for Burry, it's worth noting that he has issued several warnings over the last year and a half about the kinds of risks that in the past have encouraged investments in stores of value such as gold, including financial market volatility, persistently higher inflation, and rampant consumer debt. There's no way to know if Burry and Paulson are onto something this time around, so always do your own research and come to your own conclusions. Here's what we do know: that a select few of those responsible for the management of fortunes are diversifying with gold to help them successfully navigate what one leading asset manager has described as the most fraught global environment since World War II. Growing up in the finance world, I had a mentor who told me that I should follow smart money. I believe what he meant by smart were people who knew things that I didn't know. So you have to ask yourself, what is it that central banks, hedge funds, and investors like Burry and Paulson know that we don't? That's why I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.